So we're now going to continue our conversation about prediction markets, which is going to be about the rest of this conference. And I'm really thrilled and excited to introduce Professor Karl Whelan. So Karl's a professor of economics at University College Dublin. And previously he worked for the Central Bank of Ireland and the Federal Reserve Board in Washington, D.C. So recently he's focused on the economics of betting and prediction markets. And so Professor Whelan's here to discuss his jointly authored paper on prediction markets, which is actually based on Kalshi data and is titled Makers and Takers. And he provides some very interesting insights about the structure of bets made there and on sports markets and the outcomes of these bets. So Professor Whelan, welcome, and thank you for being here with us.
Yeah, this is a research project joint with two of my co-authors at UCD. I want to give a particular shout out to Wan Ing, who collected all the data from Kalshi's API, which is not my comparative advantage at all. So what I want to do in terms of a plan for the talk is give a brief description of how prediction markets work, using Kalshi as an example, then present some evidence that we collected and published in this paper on pricing at Kalshi, documenting some interesting patterns. And then I'll talk very briefly, this isn't a 90-minute academic seminar, I'll talk very briefly about the theory that we have in our paper that explains at least some of the findings that we come up with. And then I thought for a conference like this, it would make sense for me to give some predictions about prediction markets. And I'll base that partly on my ongoing research in relation to sports betting and some comparisons of Kalshi and the US style prediction markets at the moment with what we see from Betfair, the UK betting exchange. Okay, so how does it work? So these are simple yes-no contracts, as the previous speaker was talking about. The winner gets $1. The dollar comes from money that the two sides put in. So one side backs yes, one side backs no. If it's a 70-cent yes contract, then they put in 70 cents. The other side has put in 30 cents. And if it's a yes, then the person with the yes contract wins the other person's 30 cents. Kalshi have a very nice description on their website of precisely the market microstructure in terms of how trades happen. They say you can think of every trade in the platform as a deal taking place between two participants, a maker and a taker. The maker is the first one to the table. They declare a side they're willing to buy, yes or no, how much they're willing to pay, and how many contracts they're looking to buy at that price. Takers can see all available offers and match with the most generous one. I'll describe that in detail just a little bit more. The other element that is new relative to the historical academic research that was done in prediction markets in things like the Iowa electronic markets and predicted and so on is there are fees. These prediction market businesses are not charities. They're in it to make profits. And our data comes from Kalshi, and historically our data during the period that we look at, only takers were paying fees. That fee structure is slightly complicated looking. I'll say a bit more about it later, but it's 0.07 times the price times 1 minus the price in dollars. So worked through example here, roughly for a 50-cent contract, that's about 1.75 cents. So it's 3.5% of the cost of the contract, which is not trivial. Fees for makers were introduced after we finished our sample in 2026. But currently, at least on some markets, the makers are paying a quarter the amount that the takers are paying. Okay, what does the market look like? We've got a specific example here that we showed in our paper. This comes from one of the markets in the April 2025 April CPI. So you could pick, would inflation April CPI be above or below some number? So the one we picked, you can walk straight in to Kalshi and you can click on this thing and you can get yes for 32 cents. Okay, that's the simplest way to use any prediction market. That's you're being a taker for yes. Alternatively, you could do what's happened here, which is you could say, well, I don't want to pay 32 cents. I would prefer to get it for cheaper, and I'm going to put an offer out there that I'm going to be a market maker, and I'm going to hope to get it for 28. Okay. Now, if you do that, you've offered this amount of money. We can see there's not a lot of money actually at either the bid or the ask, as they're known. There's only 33.60 here and 16.80 here. But if you get, if you were the guy that put that 16.80 in and somebody accepted it, they would get a no contract for 72 cents. We can see the guy that offered this 32-cent contract is going to get the no contract for cheaper, right? So so it's going to be 68, right, as opposed to 72. Okay, so they're the four things you could do. You can either take yes, take no, or you can try to make a contract at a better price. Now, the obvious trade-off here, since the makers are clearly getting better prices, the trade-off here is you might not get matched, right? If we look at the interface here, you'll see, okay, 16.80 and 33.60 are small, but if you try to make an offer to buy 27 cents, you're going to be stuck behind $2,700, and you may never rise to the top of the queue, in which case, and you won't get matched. We can also see that how supply and demand directly moves prices on prediction market. If somebody comes in and takes all of these 32-cent contract, right, that $33.60 is all taken, that will go away, and the headline price will now be 33 cents. So literally more demand for yes raises the price for yes. But that's the strategic trade-off in terms of the decisions that people are taking. I can take at inferior prices, or I could try to make, but I'm not sure I'm going to get matched. Okay. Some evidence on Kalshi prices. So we collect these all from Kalshi's API from the start in 2021 through until April 2025, which was prior to the introduction of the makers fees. We use pretty much all the markets apart from the hourly markets on what's the value of Bitcoin going to be, or the stock exchange, or so on, which would have swamped our data set. So we've got 12,400 events, and they're all open at least 24 hours. Some of these are simple yes, no. Others are, things like who's going to win the Oscar for Best Actress. So there could be 10 different markets. So the 12,400 events translate into 46,282 individual yes contracts. And we recorded these prices up to 10 days before the closing. So I'll show you in a minute how that shakes out. So in the end, we have 313,000 different contracts that are either yes or no. And remarkably, thankfully, Kalshi records who was the maker and who was the taker. The funny thing here was, I've done this research with Betfair Exchange before, and they don't record this. And I developed a very complicated algorithm for figuring out who was the maker and who was the taker. And we used that first before Wanning dug into the data and said, no, we don't need to do that. Kalshi already provided that information. It turned out my algorithm wasn't too bad, but we know which side was the maker, which side was the taker. To give an example, if we go back here and look at this case, we can see the last trade was the 28 cents. So we can see the last trade came from this being accepted, not the 32 being accepted. Okay. So we have a lot of closing day only. We have a lot of 24-hour contracts, and 19,000 of our contracts are 24 hours or less, or 24 hours. We only have the last 24 hours. There's another 13,000 where we have another day, and then it strings out all the way down to, with the numbers getting smaller, before we have a bunch of very long-running contracts, 6,700 contracts for different events that we have, all for 10, 9, 8, all the way up to. Now, the good news. Prediction markets have long been extolled for their possibility for generating accurate predictions of all sorts of events. And a great advantage of firms like Kalshi for society, potentially, is by offering this very broad range of markets and lots of things, we get to use the wisdom of crowds and see what the average prediction is from the market, from people willing to actually, put their money at risk as opposed to simply surveys or whatever. And what this is this tells you the winning percentage for all of the different possible prices that we see in the Kalshi data set. And it's a pretty simple chart. If I buy a Kalshi contract for 50 cents, then we kind of hope that means it wins about 50% of the time. And so we're checking here against a 45-degree line. And what we can see is that that's basic. That's a pretty good forecast, right? Certainly as the Kalshi price gets bigger, it becomes more likely to happen. And it's a reasonably straight upward sloping line. So the big picture conclusion on Kalshi pricing is that Kalshi prices are pretty good indicators of the probability that something's going to happen. We also found that when we were able to follow contracts in, up to the closing day, we found that the forecasts get more accurate over time. So these are the mean absolute errors. So as more information is coming in and coming in, we see the forecasts get better and better. There's usually a big decline at the last day. Often, by the last day, perhaps, people have a pretty good idea of how the event is going to resolve itself. Well, we see the aggregation of information over time, which again is something that you hope that these prediction markets can do. Okay, but the prices are not perfect. If you stare long enough, you notice that there is a pretty systematic pattern of the average prices down here winning a little bit less than the prices suggest they should. And of course, the flip side is that these ones up here win a bit more. The academic version of this talk consists of a lot of tire kicking, right? And the big 90-minute seminar version about how robust this is and regressions and all that stuff. It's incredibly robust as a finding. It holds across multiple different types of markets that are just yes, no, markets that have 10 different options. It holds across different time horizons. You can see it 10 days out. You can see it on the last day. It holds across lots of different categories: entertainment, politics, economics. It holds for each year that we collected the data for. It holds, I was a little surprised by this, it does not seem to depend a lot on the underlying volume. Higher volume Kalshi markets are not less likely to have this, as at least in our sample. And we also looked at transaction sizes, which are also available, and it does not, you find it for high transaction sizes, for low transaction sizes. The other thing to note is that these look like relatively small pricing errors in absolute value, but as a percentage of the total price, these are pretty large errors down here. If I buy a Kalshi contract for 10 cents and it wins 7% of the time, that's 30% of my money. It also turns out that the taker fee is a higher percentage of the price paid for the guys that buy the cheap contracts. So the average returns on Kalshi contracts of investments look like this. Now, this is the post-fee return, but the return without fees, without takers' fees, basically, the chart looks nearly the same. And is at first a little surprising. You kind of look at this and you go, well, the typical Kalshi contract seems to be losing a lot of money. But we have to remember, in the aggregate, these people are just swapping money, right? So the average return is zero. But when these guys down here lose 2 or 3 cents, that's a big fraction of their investment, whereas they lose it to these guys up here, and that's not much of a fraction of their investment. But you can certainly lose a lot of money on Kalshi buying these low-priced contracts. Separately, because we know who's the maker and who's the taker, we can also figure out how they're doing in terms of their rates of return. And what we see is that this so-called favorite long shot bias pattern is available. You see it for both takers and makers, but it's more extreme for makers than it is for takers. And it's not just that the makers are paying a fee and that the takers aren't. It's systematic, and you see this in pre-fee returns as well. Now, what explains those results? we have a whole theory model in the paper. People have heterogeneous beliefs about the likelihood that the event is going to happen. That's realistic. That's clearly what makes these markets exist. And people have to pick to be makers or takers, and they have to pick yes or no. And in the model, the equilibrium is where everybody picks the action that they think is just the right thing for them to do. And what we find in the model is that the people with more extreme beliefs are the takers, because they look at it and they say, look, I think I'm getting a high return at this price. Now, yeah, I could seek a cheaper price, but I might not get matched. And I don't want to risk giving up this great return in order to do that. Now, unfortunately, we assume wisdom of crowds. So unfortunately, for these people with more extreme beliefs, it means they're more extremely wrong. And so they're willing and able to take prices that are worse prices than makers do. So that introduces an element of why it is that makers do worse than takers. But here's the output from our model. With that as the only sort of, element distinguishing between people, we get returns for takers and returns for makers. The returns for takers sort of match the data a little bit, but not quite. Returns for makers definitely don't match. The makers all make money, right? These guys down here buying cheap contracts, they get to have lovely things happen to them, like somebody buys a contract on the other side of them for 99 that should be worth 98. And so they get to buy a contract for one that wins 2% of the time. That kind of thing goes on with them. So this is clearly not explaining what's happening in the data. So instead, we introduce some bias into beliefs. So it's well known that people tend to underestimate the probability of small, low probability events with low chances of happening. This is documented widely in behavioral economics. It's a crucial part of Kahneman and Tversky's prospect theory. So we have a very simple parameterization of this with a parameter that basically says if beta is 0, people price exactly right, and as beta, or people understand probabilities exactly right, and as beta gets bigger, people start to inflate small probabilities and reduce big probabilities. Now, we found you needed something like this to match the data, but the beta that fitted the data best was 0.09, and it turns out that's a pretty small distortion. So, for example, if the probability actually is 15%, then the average in our would be 18%. I don't want that. So a relatively small bias in terms of the average belief is what we found. And here's how the model matches the data on the makers and the takers. And the answer is it matches it pretty well. I mean, it's been engineered to find the best possible fit. But we think these two mechanisms, people disagreeing while on average being correct, and people overestimating small probabilities, explains the prices that we see on Kalshi pretty well. Now, we can see that makers are making money off this. And so an obvious question is, why hasn't this been competed away? We'll talk about this in the paper. One argument is that a lot of these markets are very small volumes. And so the kind of professional investors that go in and arbitrage these kind of things away maybe haven't existed in the sample that we've looked at. The second point, more sort of basic finance point, is these things have huge Sharpe ratios. The standard deviations of the returns are huge compared to the average return. So average returns for the makers are something like 2%, but the standard deviation of the return of the contracts, which either win, get you 1, or they lose and you get 0, is 33%. So you could, from a sort of a Markowitz perspective, maybe they're not such great investments. This brings up the old question that Paul Samuelson's questions over the years about, well, does aggregating, does making 100 of these investments now make it more attractive? And Samuelson always said, well, if you don't like one, you shouldn't like 100. And other people disagree. The final possibilities we discussed in the paper, and I'll say more about this in a second, is maybe just give it time and people will come in and discover this anomaly. Often financial market pricing anomalies that are documented in research disappear over time. Okay, finally, some predictions about prediction markets. The first prediction I have is I do think the kind of bias that we see and the very poor returns for low price contracts, I do think that will probably disappear over time. And that's not just based on speculation. In other research, I've used data from the Betfair exchange. Now, Betfair is a betting exchange, but spoiler alert, betting exchanges are prediction markets. Okay. So high volume prediction markets, everyone's very excited about this in the US. High volume prediction markets have existed going back to the early 2000s. Betfair processes about 10% of the volume of sports betting in the UK, and sports betting is huge in the UK. So we have an idea what a mature prediction market would look like with investors that understand, participants that understand what's going on. And you don't see anything like the bias that you see on Kalshi in the prices that are generated on Betfair. Average prices on Betfair are pretty much correct. You do see takers do worse than makers, which is what we'd expect. But average pricing is pretty good. So I expect pricing on prediction markets, as familiarity with them grows, as sophistication grows, to become less biased. Second point is I think fees will fall. The P times 1 minus P formula that Kalshi have is clever, but also a little hard for people to understand. But one way to think about this is if P is also the chance that you win, then there's a chance P that somebody wins 1 minus P, and there's a chance 1 minus P that somebody wins P, right? So the expected winnings are 2 times P over 1 minus P. So that's basically the base that Kalshi, you can consider Kalshi to be pricing off. And Betfair Exchange have a commission on winnings. So their commission on winnings is 2%. So essentially Betfair are collecting 4% of P times over 1 minus P. Right now, Kalshi are collecting 8.5. So that's more than twice as high. Now, you could say, well, maybe Kalshi will end up being the dominant exchange and they can set the pricing at whatever they want. Maybe, maybe not. But what we see in Betfair's case was being the dominant exchange did not help it charge high fees. Betfair used to have much higher fees than 2%. And even though it has 90% of the UK betting exchange market, its sort of scrappy competitors, the main thing they could compete on, not liquidity, because Betfair has far more liquidity, but they could compete on price. And that pretty much forced Betfair down to this 2%. And I predict the outcome in prediction markets will be relatively low fees. I also think from my experience with Betfair that the sporting products need to have the accoutrements that you get from a sports book. So Betfair Exchange has the live score. It tells you about what events are going on. When major events happen, the market gets suspended. People won't feel that they're getting killed by more sophisticated makers who have like kind of low latency feeds. You're watching the game and you see a goal and you've already, somebody else has already made money off that. I think those features probably need to be integrated to any market in which sports is going to be a big element. And the last thing, and this is kind of sad, I think the kind of interface that we have that you see on Betfair, the kind of interface that you see on Kalshi is fantastic. The two-sided makers and takers and exchanges are certainly in the UK priced with the 2% commission, much better value for people placing bets on sports than betting with bookmakers. But they've had 20 years and they have not particularly prospered. That 10% market share hasn't really budged. Now, there is a small issue there. Betfair is owned by Flutter, who also own FanDuel. They own a bunch of bookmakers. It's not clear that Flutter, as a conglomerate, wants Betfair to succeed and wipe out sports books around the world. But even then, Betfair had been going a long time before this particular merger. People just find the exchange interface difficult, and they only really understand taking. Kalshi's UI it's beautiful, but I think most people just want to be takers, And unfortunately, we're already seeing now with sites that are like DraftKings predicts and the FanDuel version of them, they're modeling them, calling themselves prediction markets, but you go on and the UI is just for takers. And there's the institutional money. It's either DraftKings themselves or else it's institutional money. I think the FanDuel, the money comes from the CME. And so I think that may be, at least for sports betting, I think that may be the future of prediction markets. With the caveat that, of course, all of this may just end up being declared illegal by the Supreme Court at some stage, which is not something I'm going to make a prognostication on.
Thank you so much. That was super interesting. I think you did a great job explaining how these markets work for the uninitiated, and also comparing and contrasting with other markets that are analogous. I think was really helpful and provided some key insights about kind of the accuracy, which is pretty interesting, and then sort of the winners and losers, and if you want to bet on these things, how to do so successfully. So really appreciate the approach there, and thank you so much for sharing these insights with us.